This week on Newsmakers, Doug Elmendorf, who is the director of the Congressional Budget Office, and also two reporters with us, Damian Paletta of the Wall Street Journal, economic policy reporter, and Eric Wasson, congressional reporter with Bloomberg News. Mr. Elmendorf, let me just begin with, for those outside of Washington, what is the Congressional Budget Office, and what's your takeaway from Wednesday's report?
CBO's role is to provide the Congress with nonpartisan, objective information about the budget and the economy. We've been around for almost 40 years, and our job is to just help the Congress understand what the consequences will be of current laws and also what the consequences would be of alternative policies that they're considering. One of the ways in responsibility is to provide regular projections of the economy and the budget under current law. Yesterday we released our summer update to the projections we'd released earlier this year. What we found in reviewing the evidence about the economy and the budget is that the overall picture isn't much different from what it was in the projections we released earlier in the year. The economy, we think, is on a path of recovery, but it has been a disappointingly slow recovery. We do think now that growth will pick up over the next few years, and the labor market will strengthen, more people will find jobs. But even with that pickup and the improvement in the budget that that will bring, because of underlying trends, the federal budget is still on an unsustainable path, because although deficits have come down the last few years, a few years from now they will start increasing in size again. And the debt, the outstanding debt of the federal government is very high relative to the size of the economy in our history. And by the end of the coming decade and beyond that point, that high level of debt will increase even more relative to the size of the economy. And that high and rising debt has serious negative consequences and ultimately couldn't be sustained.
Can you tell us a little bit about, we've seen really strong growth numbers for the second quarter. We've seen really good numbers on jobs created each month for the past few months. But there does seem to be a real disconnect with a lot of Americans. When they're polled, they feel like we're still in a recession. What is the disconnect between what people feel at home and these kind of numbers that we see? The stock market's obviously really high, but we also have almost 50 million people on food stamps. What's going on right now?
Well, economists generally define a recession as ending when the economy stops contracting and starts growing again. But the economy contracted so much in this country in 2008 and especially the first half of 2009 that the actual output of the economy fell way below what we could produce if all of the people who wanted to work were back at work, if all of the plant and equipment businesses had was being used, and so on. So although the economy has been growing now for 5 years, it's been growing from a level that had fallen well below what we'd had before the downturn. And that growth that we've had has not been fast enough to put everyone back to work who wants a job. And you can see that partly in the unemployment rate, which although it has come down quite a bit, is still higher than it was in 2007 and the years before that. But you also can see this in the labor force participation rate. This is just the share of the working age population that is actually employed or looking for a job. And that participation rate has fallen very sharply in 2010, 11, 12, and 13, although now it has leveled out since late last year. And we think part of that is underlying demographic trends, but part of that is people who became discouraged because they couldn't find a job. So we think that as the demand for firms' products increases in the next few years, the unemployment rate will come down further, but also some people will be drawn back into the labor force when they find better job prospects, and we think ultimately faster increases in wages.
Are wages the last thing to usually catch up in a recovery like this?
Wages can catch up slowly. This particular business cycle has been so deep and the recovery so prolonged that whether the traditional patterns apply exactly in this recovery isn't so clear to us or other analysts. And that's part of the challenge that we and other people face in making projections. But wages tend to recover only when firms are finding that they're trying to hire more workers and can't get workers at the existing wages. And they haven't really come to that point yet.
What if that doesn't happen? What if these typical trends that you're looking for, what if they don't play out? And the wages stay stagnant, wages have not, or people are coming back to the workforce, but they're taking part-time jobs?
Well, if the wages don't pick up, then there will be fewer people who will come back into the labor force. Some people will decide that given the other costs they have of working, or the things they would do if they weren't working, they won't actually find their way back to work. But also for many, many people who would be working, they would just have lower incomes than otherwise. For a long time in this country, the share of total income going to workers and the share going to the owners of capital through profits or interest payments, those shares tend to be fairly stable. And we've really deviated from that now. For a few decades, in fact, there's been a downtrend in the share of income going to workers. But that gradual downtrend turned into a sharp fall. And we have not seen recovery from that. Now, in our projections, we think there will be a recovery, not back to the previous average level, but a recovery from where we are now. And I think there's every reason to think that will happen, but it will take businesses feeling enough demand for the goods and services they're selling that they need to hire more workers to produce those goods and services. And in order to hire them, they'll need to feel the need to pay higher wages. We think that is coming, but it has not happened yet. Growth of wages remains quite subdued relative to what it was before the financial crisis and the recession.
Mr. Elmendorf, on economic growth predictions, almost every year it seems like CBO says the year after this there's going to be a sharp uptick in growth. Why should investors believe CBO this time when you say next year and beyond we're going to see a much higher rate of growth?
Well, everyone who looks at our economic forecast should recognize that there's a tremendous uncertainty about the forecast. One thing we do every few years is to publish an analysis of the accuracy of our forecasts. And we find that our forecast is no worse in general than the forecasts of outside forecasters. But that's a pretty low bar just because economic forecasting is so difficult. So we have been disappointed now a number of years in a row. And in retrospect, we think we misjudged how long the damage from the financial crisis and the housing bust would last. There's plenty of evidence across different countries over long periods of time that economic downturns that follow housing bubbles and that involve real problems in the financial system tend to lead to very slow recoveries. But in the United States, I think a number of people, including we, felt that because monetary policy and fiscal policy had responded initially very powerfully to the downturn, that in the United States, in this occasion, we wouldn't have as long and protracted a recovery as has happened in many other countries. Now, it's still true that we've done better in this country than many of the countries in Europe have done. So relative to other countries in this particular cycle, the U.S. has done a little better, but it has still been a much slower recovery than we had expected. And what we had expected was slower than the average U.S. recovery.
If I can just go on to a question about the deficit for a second. The way I read your report is, Congress in the last year or so has pivoted away from the deficit. It's not the #1 thing being talked about. And when I look at your report, deficits year on year are declining, but you talk about debt increasing over time. Would it be fair to read your report as saying that it's a mistake for Congress to turn away from concerns about the deficit?
We certainly think that the fiscal challenges the country faces remain very large. We had expected all along that as the economy improved, deficits would fall for a while. That the real challenge always lay in the sort of medium run and long run. And the challenge comes, as you know, primarily from underlying forces like the aging of the population and the movement of the baby boom generation into retirement, and from rising health care costs. And those challenges basically remain. So we have obviously made adjustments to our projections over the last several years, partly in response to actions that Congress has taken. But nonetheless, deficits over the next decade are large enough, more than $7 trillion, we think, over the coming decade, large enough that the debt held by the public will increase relative to the size of GDP. And even this year, debt will be is larger now relative to the U.S. GDP than it has been since 1950. And by the end of the decade, we think it will be larger relative to GDP under current laws, and then increasing beyond that. So those high levels of debt have, in the long run, significant consequences. And unless the Congress acts to address them, those are costs that we will bear. And ultimately, something will have to be done because debt can't rise indefinitely relative to the size of the economy.
And I know you don't endorse specific legislation, but what are the types of things Congress should be looking at doing? I mean, you have said generally in the past.
Yes. Well, so one of the things we provide to Congress every few years is a thick report of many, many options for addressing the budget, some on the spending side, some on the revenue side. As you say, we don't take positions about which are good or bad. We try to lay out the pros and cons of all of them. But the way we think about the budget, let's start with the spending side, is they're spending for a few programs, a few very large programs that is growing quite rapidly. And we're thinking here of Social Security and of the major healthcare programs, which include Medicare and Medicaid, and now the subsidies through insurance exchanges. And spending for Social Security will grow about 80% over the coming decade. Spending for the major healthcare programs will grow 85% over the coming decade. In sharp contrast with that, spending for all the federal government's other programs, defense spending, highways, veterans, healthcare, a whole slew of activities, all those other activities put together, spending is growing much more slowly than it is for those few large programs. And partly that's because the Congress has put in place caps on the annual discretionary appropriations through 2021. So I think many analysts, seeing how much those caps would restrict spending in those areas relative to the historical experience, are focused on the other sorts of spending, primarily in Social Security and in major healthcare programs, as an area where changes might be made. And the other side, of course, side of the budget is on the revenue side, and we've analyzed a whole range of options for increasing revenues. That can be done in a broad-based way, or it could be done in a way that's more targeted.
There was not a CBO director when they made Social Security or Medicare, so no one was burdened with trying to sort the numbers out for that. But you had to, not too long into the job at CBO, had to figure out the ACA, and there was a lot of, obviously, national attention on the job you guys did. And the bill was kind of tailored to fit with the CBO's estimates. Do you think, in retrospect, you guys got that mostly right, your estimates on that? Were there parts of the ACA that surprised you in retrospect for being too expensive or less expensive? And what impact has the ACA had also on healthcare costs? That's a big debate right now as well.
Yes. So on the question of whether we were right or not, we don't know. And I think in some important ways we will never know. So for some provisions of the Affordable Care Act established new streams of money that one can identify separately. So the Affordable Care Act has established credits to help people, tax credits to help people buy insurance through exchanges. And those credits didn't exist before the ACA was put into place. So we can ultimately assess how much money is being spent on those credits and compare that to what our projection was. But it's still very early for that, of course. This is the first year in which those tax credits have actually been available.
Right.
Now, the enrollment in the insurance exchanges this year is very close to the projections that we made earlier this year, and in fact our projections from a number of years ago. But this is just the first year. So we don't know what enrollment will be in the exchanges. We don't know what the cost of those credits will turn out to be. And then other provisions of the Affordable Care Act made changes to pre-existing programs like Medicare. Well, in some ways we will never really know what effect those provisions had, because Medicare spending would have happened otherwise. The ACA changed the payment rates and payment mechanisms and so on. But we'll know in the end whether Medicare costs more or less than we predicted it would cost after the ACA was passed. But if that turns out to be different than we expected, whether that difference comes from a misestimate of the effects of the ACA itself or just a misunderstanding of what would have happened under the law before the ACA is not something that you can readily understand.
But it's still your latest estimate that the ACA in its entirety will reduce the deficit over the next 20 years, I guess, 2 decades, compared to if it didn't exist.
We have no reason to change that assessment, but neither can we do a new estimate of that sort again today, because the ACA has now been in place for 4 years, and its provisions are intertwined with other provisions of the pre-existing law in ways that we can't readily separate out. But we have no reason to change. Nothing has happened that invalidates that projection, but at the same time, it's not something that we can readily confirm.
Sticking with healthcare, what trends are you seeing with Medicare spending?
So healthcare spending in the country as a whole, and in Medicare in particular, has slowed very sharply over the past several years. And there is a fair amount of research being done to try to understand why that slowdown has occurred. And we've been one of the participants ourselves. We focused on Medicare. And in the work that we did in the paper we published last year, we found that the business cycle problems, the slowing income growth, the loss of wealth, does not seem to have been a factor in the Medicare cost slowdown. We think what's really going on in Medicare is changes in the way that providers of health care and the beneficiaries of Medicare are behaving. In the economy, in the healthcare sector as a whole, there's more dispute about how important the cyclical slowdown has been. But I think there's little doubt that there are important changes going on in the healthcare system, and that they have been important in slowing the growth of Medicare costs to the point where Medicare spending this year is rising more slowly than the number of beneficiaries. So that the cost per beneficiary in Medicare this year is actually going to be less than the cost per beneficiary last year.
That seems like good news. Do you expect that trend to continue?
That is good news, I think. There are a number of factors that we think are going on in Medicare. As I say, we think there are changes in the way providers and beneficiaries are acting. There also are restraints on the rates that Medicare is paying to providers for the services they deliver. And there were some before the Affordable Care Act, and the Affordable Care Act added to that. There's a third feature which people often don't think about, which is that as baby boomers move over age 65, move into Medicare, they raise the number of people getting Medicare benefits. But 65-year-olds tend to be much less expensive than 75-year-olds or 85-year-olds. So there are a growing number of people getting Medicare benefits, but they tend to be the healthier ones. That also is holding down the cost per person over this coming decade, although pushing up the total costs. So all those factors are at work, and our projections try to sort them out and to give them the appropriate weight going forward. We're pretty good at knowing how many 65 and 75 and 85-year-olds there will be in Medicare 5 or 10 years from now. But it's much harder to know what the behavior of beneficiaries and providers will be. So we think that we think the slowdown we've seen, the slower growth rates per person will persist for a while. And over the last 4 years, we have brought down our projections of Medicare spending, say around 2020, by about 15%. That's a very sizable reduction. The total revisions we've made to Medicare and Medicaid spending because of this sort of slower growth of health care reduces federal spending by more than $1 trillion over the coming decade in our projections. So we think that it's a real phenomenon that was making a very big and very positive difference for the federal budget. But I want to emphasize that notwithstanding that slowdown, there will be many more people receiving Medicare benefits, more than a third more people on Medicare 10 years from now than there are today. And even if each individual person's costs aren't going up very fast, that still means a big increase in the overall cost of the program. In addition, there is this expansion of federal subsidies for health insurance under the Affordable Care Act through the subsidies and the tax credits and insurance exchanges, and also through Medicaid. So the number of beneficiaries of federal health care programs are going up in that way as well. So the slowing in cost per person is a very good thing for the federal budget. But notwithstanding that, still, total federal spending on the health care programs is the fastest growing large part of the federal budget.
Mr. Elmendorf, I have a question of personal interest. I'm someone contemplating buying my first home. What can you tell me about interest rates? What are they going to do, and what's that going to mean for the economy?
Well, I can't give you any personal financial advice, nor will you necessarily want mine. Right. But interest rates have been very low, obviously, in the last several years, because there's been a very weak private demand for credit, and because the Federal Reserve has been trying to stimulate the economy by holding short-term interest rates down and by buying longer-term securities. We think that with the economy healing and with the recovery we expect in the labor market over the next few years, that the Federal Reserve will start to raise rates. And our projections aren't too different from those that you see in prices in financial markets. But the increase in interest rates will have very important effects on the federal budget. The federal government owes a lot of money, and any increase in the rate that it pays means larger federal interest payments. So between now and 10 years from now, we think the outstanding federal debt will increase by a lot. We also think that the average interest rate that the federal government pays will more than double. And because of that, the total interest payments the federal government makes will more than triple over the next decade, from more than $200 billion today to essentially $800 billion in 2024.
How will we know when we're in a quote-unquote debt crisis that some people talk about? Is there a dividing line when we know we're into some sort of spiraling debt crisis?
The way that we use the term fiscal crisis is a point at which investors become sufficiently worried about the government's ability or willingness to pay its bills that they start demanding much higher interest rates. And in other countries, that shift in perception tends to happen fairly rapidly, partly because if somebody starts to worry, and other people start to worry as well, and as interest rates then rise, then in fact it becomes harder for a government to pay its bills, and the worries can be self-fulfilling in a way. The U.S. is not in that position. The Treasury is currently paying quite low interest rates. Whether we might end up in that situation, we just don't know. And by we here, I think I'm trying to refer to analysts in general. We think there's not sufficient ability on the part of analysts to predict when that shift, that loss of confidence, would occur. But certainly higher debt raises that risk relative to lower debt. In 2007, federal debt held by the public was about 35% of GDP. This year it will be about 74% of GDP. And as we say, basically higher by the end of the decade and higher still beyond that.
We have time for a few more questions.
When you look at on the horizon, I mean, it looks like when we're looking at your data, 2017, 2018 is when we get to that inflection point where we'll have had several declining deficit years, but we're going into this pickup where we're well into the baby boom generation, moving into these programs, and there's other issues as well. Is there an issue on the horizon that people should be the most cognizant of that's going to really propel the debt to grow in perpetuity, or is it just a combination of factors that's really the issue?
I think it's really a combination of factors. I mean, we have the retirement of the baby boomers. We have this expansion of federal subsidies for health insurance. We have rising healthcare costs per person and rising interest rates. And all of those factors are actually at work now, but they become more pronounced as the decade goes on. And I think the key point here is that the growth of federal spending relative to the size of the economy does not come from faster growth across the board in government programs. It really comes very much from the growth of a few programs. So over the next decade of the total growth in federal spending, 85% will come from Social Security, the major health care programs, and net interest.
Wow.
And everything else accounts for only 15%. So if you're worried about the path of federal spending, it really is the focus on those programs that one should have. But the upward pressures there under current law really are inexorable because the spending of those programs depends very much on the number of people who are over age 65, and then beyond that on health care costs per person. What's happened over the last few years, and we think will happen again next year, is declining deficits as the economy has recovered, and with a stronger economy, not strong enough for everyone to have a job at this point, but stronger than it was. The stronger economy means more income, more tax revenue. So this year tax revenue is up about 8% from last year, and spending is up only 2% from last year. So that's why the deficit is narrowing. But that improvement in the economy will, once the economy gets back to its sustainable level of output, then we think the economy will grow at a lower, more sustainable pace beyond that. So the recovery of revenues that one sees now, we won't see those kinds of growth rates every year going forward.
You know, your projections don't account for the possibility of another deep recession coming up. Is it fair to say the government has less leeway to stimulate the economy due to its already high debt burden, if that were to happen?
I think the government certainly has, the higher level of debt certainly gives policymakers less flexibility to respond to unexpected challenges. That could be economic downturns, financial crises, international events. And the more debt that we have, the less ability that Congress has to do what it did in 2009 and 10, which was to start with just allow revenues to fall with the declining economy, but then beyond that to make specific changes in policy that cut taxes a little further and raise spending to provide some short-term boost to the demand for goods and services and thus to output and to employment. And the more, if we'd started in 2007 with debt at 77% of GDP, not the 35% it was at, then our ability to do what we did during this downturn would not have been there.
You're essentially the referee in a mud wrestling match, right? With like rings of fire surrounding. I mean, this is not a friendly town right now. Do you think? I know you never pick one side or the other, but can you pass any sort of judgment on the process itself? Is it beneficial? Is it serving the American people? Are there things that could be done better in terms of policy-making decisions? Not picking one or the other, but the way things are legislated.
And your answer will have to be the last. Go ahead.
I don't have recommendations for the political process. I think the fundamental issue now is that members of Congress disagree strongly about what should be done to address the fiscal challenge. And absent greater agreement among the policymakers, and I think ultimately greater agreement among the American people about how to proceed, it's very hard to make more progress than has been made.
Director Elmendorf, thank you very much for being our newsmaker.
Thank you. I'm happy to be here. Thank you.
And we are back with our reporters, Damian Paletta of the Wall Street Journal and Eric Wasson of Bloomberg News. Eric, let me begin with you, because there was so much debate on Capitol Hill in recent years over debts and deficits and government shutting down, and that whole conversation doesn't seem to be happening anymore on Capitol Hill.
They have pivoted away from it. Last year there was a bipartisan budget deal, and the sort of battles that had been raging ever since Republicans took over the House seemed to subside. What I thought was interesting was that Mr. Elmendorf was basically saying, he didn't use the word mistake, that they need to come back and re-engage in this. Now, you see from the White House and Democrats noting that the deficit this year and next year are going to be below the 3% of the economy that's been historical average over the last 40 years, and basically giving the impression that the deficit problem is solved. On the other side, you see Republicans pointing to the debt that's accumulated due to the great increase in government spending during the recession and saying that we're headed for a debt crisis. And I think Mr. Elmendorf sort of went right down the middle and said, we are seeing an improving picture, especially due to things like Medicare spending being reduced, but he'd like to see Congress come and re-engage. And I think that we will see in Washington in March or a couple months after that, the debt ceiling needs to be raised again. This is something that's caused a massive flurry of activity in the past, and that's one potential to see Congress either re-engage in this or actually make the deficit worse, which was something that happened in 2011 when they did scare the financial markets by refusing to raise the debt ceiling at first.
What are their options, really?
Well, again, Mr. Elmendorf laid out that there's a revenue issue and there's a spending issue. So, the idea had been for a long time if both sides could come together and do a quote-unquote grand bargain where there's tax reform that maybe raises some taxes but lowers others, and maybe in deals with both, increasing maybe the payroll tax contribution to Social Security, but cutting some benefits or raising retirement age. Now, all those things are painful. And the idea was that in split government, where we're definitely going to still have President Obama, despite some basically bogus talk of impeachment on the right next year, that a divided government is the best place to do that. I think it remains to be seen. It's probably unlikely, but it could happen.
But it's also interesting if, we had the government shut down less than a year ago. If the Republicans win the Senate, which looks like very likely they will do, maybe they feel like there's no political consequences for doing that again, and they'll be more ready to sort of stand up and fight for what they believe in when we get into 2015 and 2016. So maybe the possibility, or at least the threat of a government shutdown, could force some tough decisions on Medicare taxes, Social Security, that sort of thing.
Right, dealing with the so-called 85% that Mr. Elmendorf said. He said, if you're worried about spending, you need to focus on that 85%.
Right. Well, already Mitch McConnell has said on the appropriations process, which is the smaller percentage there of government spending, if Republicans control both houses of Congress, they can design appropriations bills and a budget for fiscal 2016 the way they want and send it to Obama and say, dare him to veto it. So they'll have more leverage certainly on that, and whether they can use a budget reconciliation process, which avoids a filibuster in the Senate, to do bigger changes also remains an interesting question.
Damian Paletta, about the Affordable Care Act, you asked him about that.
Yeah, I thought his answer was really interesting because, one of these things when you have people, keeping score, making projections, you want to know if they were right or wrong in retrospect, and his point was we may never know if we were right or wrong, right? Because the Affordable Care Act sort of changed the health care spending landscape so much that it's hard to measure what things would be like in absence of it ever existing. So I think my sense is that they feel pretty comfortable with where they are. Obviously, there's been so many changes after the law was passed and continue to be changes from the administration that it is probably hard to exactly measure what the impact and cost will be. But my sense is that, this is a legacy issue for Obama. It's kind of going to be a legacy issue for Elmendorf when he leaves CBO, because this is one of the biggest things that they had to judge, and all the attention was on them.
Well, is Mr. Elmendorf leaving, staying? What's his future?
That's a great question. His term ends in January. He's appointed by Congress. There's this sort of confusing rotation that goes on, and his situation is even more confusing because he came in to fill like an unexpired term when he started in 2009. If I had to guess, I would guess that he would not stay past January. He's been there a while. If the House gets to decide who the next person is, Elmendorf is a Democratic appointee. I'm sure the House will want their own person in there. Elmendorf's been doing this a long time. He might want to do something else.
Well, actually, when I was at my former publication, The Hill, I did a story about this, and I had Republican sources close to Tom Price, who's likely to be the House Budget Chairman because Paul Ryan is moving on to Ways and Means likely, indicating he would be open to keeping Elmendorf. And Jeff Sessions, who would likely be the chairman of Senate Budget, also said he likes Elmendorf. And the reason I think people were saying is that if they try to present a very conservative budget, they want a neutral referee judging it. Like the idea that they would install a hand-picked referee and then do the budget might give the budget less credibility. So I think there's a possibility he could be allowed to stay on, but it does remain to be seen.
All right. Well, Damian Paletta, Eric Wasson, thank you very much for your time. Appreciate it.
Thanks.